Before you even see your paycheck, a massive chunk of your earnings is gone. The average salaried employee hands over 30% of their income goes to taxes right off the top. Meanwhile, some of the wealthiest people on the planet legally pay a smaller percentage of their income in taxes than their own secretaries. This gap doesn't exist because of illegal tax evasion or hidden offshore bank accounts. This is the tax system functioning exactly as it was mathematically designed to work. If the law is being followed, we have to explain this central contradiction. How does someone control billions of dollars in assets while reporting almost zero taxable income? The answer lies in one singular rule that governs the entire financial system. Income is taxed, wealth is not. This flowchart shows the two paths. If you earn a salary, your money travels down this first path, getting hit by taxes the moment it's earned. But the ultra-wealthy store value in appreciating assets, like stocks, real estate, and businesses, which bypass that filter entirely. Having billions of dollars in paper wealth means nothing to the tax authorities. The government only applies a tax when those assets are sold and converted into cash. That moment is the taxable event. For the ultra-wealthy, the objective is to find a way to fund a lifestyle using that paper wealth without ever triggering that specific event. They achieve this through a strategy known as buy, borrow, die. It begins with the buy phase, placing every possible dollar into assets that grow in value over time. Selling these assets to pay for things would trigger capital gains taxes. To avoid that, they simply never sell. They shield the minor income they do have through business structures. Costs for vehicles, travel, and home offices become pre-tax business deductions, reducing their taxable total before the government can touch it. Real estate offers an even more powerful shield. As this chart shows, a property's actual market value and cash flow can rise on the top half, while the owner claims a paper loss through depreciation on the bottom half. They report a loss to the tax office while they're actually making money. By holding on to appreciating assets and claiming these structural paper losses, the wealthy build a fortress of value that remains invisible to the tax code. But the high-end lifestyle still requires cash. To get it without selling assets, they move to the second phase, borrow. Instead of selling, they use portfolios as collateral for cash loans. Since a loan is debt, zero tax is owed. The interest rate is significantly lower than capital gains taxes. Meanwhile, the growing assets use dividends to automatically pay off the loan's interest. Debt, which typically drains the wealth of the middle class, is used here to create a tax-free stream of liquid cash. This leaves a lifetime of borrowed money and accumulated growth. The final question is when the bill eventually comes due. That leads to the final phase, die. The tax is deferred indefinitely. When the individual passes away, the assets and the accompanying debt are simply handed over to the next generation. Specialized legal structures like trusts allow this wealth to bypass the inheritance taxes that would otherwise claim a significant portion of the estate. This final transfer ensures the untaxed empire remains intact, resetting the cycle for the next generation. The tax code functions as an engineering manual for those with capital. It is a set of instructions written to reward specific economic behaviors. The rules prioritize business ownership, long-term asset holding, and strategic borrowing. But because salaried employees have their money taxed at the source, they are structurally excluded from these specific advantages. This divide means that while a salary is often a finish line for tax authorities, wealth is a starting point. Building real momentum requires shifting the focus from earning income to owning assets. You don't need a massive portfolio to apply the logic of this system. These principles scale. For example, generating even a portion of your income through a side business allows you to apply legitimate deductions to your expenses before your income is taxed. Prioritizing long-term investing over short-term trading unlocks lower capital gains tax rates that are accessible to anyone, not just the ultra-wealthy. And tax-advantaged retirement accounts are specifically designed to mimic these tax deferral strategies for ordinary people, though they remain underutilized by those who don't understand their mechanics. The code is written to favor the growth of assets over the labor of an employee. Understanding those rules is the first step toward using them to your advantage, rather than accepting maximum taxation as an unavoidable fact of life.